you can see here this market pushing down, all right? And in this final push, in this little push here, this is an impulse, okay? And in this impulse, there's going to be structure. Let's drop our time frame down to 5 minute and have a look, all right? So I have no issues with you guys being in the 5 minute as your lowest time frame. Yeah, I think it's small enough and yet large enough for you to be able to learn something and take trades, enough trades, all right? So we can see some minor structure in here. Obviously, more major structure is going to be the top after we see that retracement, yeah? In here, it's going to be a major. Now, you see the market came down here, and then the market started to go sideways. If you was watching this trade, you draw your box in there, okay? But you don't need to draw it after a while. After a while, you'll be able to see it with your eyeballs, but there's no problems with you using your finger to read, okay? Understand my analogy. Yeah, there's no problems with you using your finger to read, especially early stages. Because let me tell you something, over the phone or over the mic, I can't hear that you're using your finger to read. Okay. Or if you have to stand up in class and read, nobody can see that you're using your finger to, that's not the biggest priority. The biggest priority is that you can read fluently and we can understand what the sentence is saying. So do not feel as though somehow you're too big and too bad and too wicked to be able to draw boxes and draw trend lines because some trader online said to you, he doesn't need to draw trend lines. You don't need to be there. Draw your boxes, draw your trend lines. Be comfortable understanding that in this little box that I've just drawn here, the market is trading within a range and going sideways. Look, I'm up here, then came all the way back down here, then came back up to here. It's not bullish at the moment until we see, watch, indication, candle closing. After that, we see correction, it coming back down here, closing up this imbalance. Now, why is it that imbalance? Because look, let me rewind so you can see it in real time what it would look like. All right. In real time, the market came down to this level, which this yellow line is already a discount. So look how we're building up our case. We're Colombo, or we're the prosecution. Yeah. It's already traded into an area of discount at the bottom of this yellow range. You can't see the yellow range, zoom out to show the people them the yellow range. All right. This yellow range. How have we drawn the yellow range? Somebody's saying, oh yeah, this guy's drawn the yellow range after the fact. No, I use this data point here and I use this data point here and it gave me this angle right here. And then I held control on my Windows machine. God knows what you have to do on a Mac. Yeah, you might have to draw it, write a code in, or I don't know, send an email or something like that to duplicate a line. I don't know. I don't have Mac. I'm not part of the Apple cult. Yeah, but on Windows machine, I held control and I pulled out a parallel line. This line is parallel. And I touched it on the lowest data point that I could have in there after the low, which was here. All right. Touched it on there. That gives me my range until I get more information. After this market retraces back here and comes all the way down here, I got to change this line and this angle. But for now, we are trading within this range. I'm waiting for the market to show me different. So this is a discount because we understand that price moves from expensive or premium to discount, premium to discount. That's all it does. So down here is a discount. So that's the first tick in the box. Yeah. Then I've seen that after the market was trading down within a beautiful little range here, just trading down within these two white lines, no issues. I've then seen the market price decide to break outside of the trend. Well, I compare this to, everybody's wearing straight jeans in the club. And then all of a sudden, you're a bouncer on the door. All of a sudden, you see a difference in the trend now. No one's coming in these tight, skinny jeans where, you can see every muscle in a man's leg flexing. The reason I use the bouncer in the front of the door is because he's seeing all the through traffic. He's seeing the trend. He's seeing the trend of man turning up with jeans that are right up in their body. And he's like, rah, straight jeans have gone mad. And then he starts to see people come in, something change here. The trend changes. Man are coming in baggier jeans. Man like, okay, looks like fashion is changing. He's not even a fashion man. He's just standing on the door watching, people watching. He's seeing people coming in with baggy jeans. It was in here before, from all the way up here, from this date, 7th of June at 5:30. It was in this range, having fun in this range. This range was containing it. Then boom, something changed. So now we're getting it price breaking outside of the market in an area of discount, right up against the wall of discount. So at that point in time, like I said, we are looking at this market, and I have no problems with you being down on the 5-minute time frame and trying to see when price is going to break outside of this consolidation. I've told you many times, a nice way for you to be able to get into trades and look for setups is go and find consolidation in good locations, in premiums or discount. All right. So we've seen here, boom, look, boom. This candle's definitely broken outside of this box after going sideways and closed over here. This is an indication of what the market wants to do. I'll be like, okay, my alert would be ringing because I had an alert at the top of this consolidation. It'd be ringing, ding, 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 ding. I'll be looking, have a look. Yeah. And price broke outside of there, indicated. Yeah. And then price, I'm watching it. When it was here and it made that indication, I can see, because Jay has told me multiple times that the market does not like inefficiencies, i.e. imbalances, i.e. fair value gaps, i.e. what other 8 million different words people want to come up for the same thing. Price doesn't like it, or markets don't like it. Markets like to go and fill those inefficiencies. Yeah, and that's exactly what the market did. I'm still not in. I will show you that there's an entry down here, possibly. I'll show you, but I'm still not in. This is the indication. This is the correction. What am I waiting for, people? What am I waiting for, family? What am I waiting for after the indication and the correction? What am I waiting for?
Continuation.
I'm waiting for the continuation. Good morning, my brother. I'm waiting to see this market here, this price close above this high. Yeah, because the market came from here, did this, and did this. Now, why am I waiting? Let me tell you something. The break, you might have heard of trading strategies, break and retest. The break and retest traders hit the button here. Now, we can hit the button here, but after we see our same strategy play out on a smaller time frame. We don't just blind and hope for the best, because we haven't got a confidence. That market could be a liquidity grab. Instead of going back up here, it could do this. Meow. And we just got stopped out. I was like, oh, we got stopped out, break and retest. Oh, don't worry about it. There'll be another one. I hear you, but you guys were kind of gambling. There was no confirmation yet this market wanted to go back up. But my confirmation is close the imbalance. Pow. As soon as I see a closure above here, and this is what the break and retest people don't understand. Because you're thinking, yeah, but the break and retest people going earlier. Look, that break and retest person that hits the button when the market comes down here, yeah, it comes back down to where it broke. That's normally break and retest, comes back down to where it broke. They've got to place their stop somewhere. Where do you think they place their stop? More than likely, these break and retest people, if they've been taught, whatever they've been taught has been worth the paper that they've received it on the PDF, yeah, it's been worth anything. The person has told them that they're going to place their stop below a swing low. Because it's such a gamble. You don't want to place your stop like this, 1 pip or 2 pips. You're going to be placing your stop below some sort of significant low. Maybe down here. Maybe down here. So either way, have a look at the numbers. Just for argument's sake, in gold. This number is still 1,233.7. Yeah? It's still that amount. Let's even go and take down here, because we're on a big time frame. Yeah? But let's even take it, below this little low here, which I'd have to take into consideration this imbalance that's in here. I know. So let's even just say around, let's go halfway. 900, let's say 1,000. They still got to place their stop there. Have a look when you enter the trade. So that's 1,000. Remember, the break and retest people had to put 1,000 pip stop. You got the indication, you got the correction, you got the continuation. This candle here closed above here. And you said, okay, cool, that's my strategy. You hit. Now, aggressive would be below the last low over here. Sensible would be below this kind of low over here. Look, we're at the same, it's like the same stop. But you've got an added confirmation. So they're not winning anymore. Not winning anymore that they've got a bigger lot size than you. They've got the same lot size as you. Maybe if you both get out of the same place, which you won't, they might have a little bit more in the deal. They're no better off for having a gamble down here than you are. What I'm going to do here is I'm going to put in different entries. Yeah. So on a 5-minute time frame, I'm going to put in this one here. I'm also going to put in an extremely aggressive one below the last 5-minute low. Now that's not great. Let me have a look at what time this was. Yeah, cool. Let me put it here also. Below this low over here, my spread times 2. Same thing, this one below this low, my spread times 2. Also take into consideration this little candlestick zone. And let's see what happens. It's doing a hokey cokey. Our aggressive entry has been stopped out. Oh, we actually nearly got stopped out of both. No, we stopped out. We stopped out both of our entries. Okay. Okay. No problem. All right. No problem. All right. So let's have a look at that now. Let's have a look and understand and see what happened here. So our market broke out of this area here. All right. Our market broke out of this. So the market indicated on a 5-minute time frame, but wasn't enough. The market wasn't happy with that. All right. So we indicated on a 5-minute time frame, corrected and continued. See, on this 15-minute time frame, this candle isn't our indication because it isn't above this wick. Okay. This is an indication of closure here. And then all of this here is correction. Okay. So in that instance, I think this 5-minute little entry here that I said that we had here, and I was happy saying, oh, yeah, I'm happy that the market came and indicated this little level in here. I said this candle in here, it was too tight. Maybe on another market, this closure here isn't above this wick. All right. Maybe it isn't above this wick. Because if it was above this, if it wasn't, and we're taking maybe this candle as a closure, the swing low, this was the closure, would be below this level here with our spread times 2. Yeah. Still pretty tight. Still pretty tight here. Still might have got stopped out here. And if that's the case, is what it is. I'm not going to adjust this and change it on the basis of, oh, just to make it work. It is what it is. Yeah, we don't know whether or not there was some overwhelming news that had a little bit more of a bearish action or not. But on a 15-minute time frame, have a look. I can see a few things straight away. Okay, so on a 15-minute time frame like this, when this market came up here to this impulse over here, like I said, this wouldn't have been a closure above this wick here, right? The closure would have been all the way up into here. And what I would be able to see, watch, is I would definitely have a look at this impulse in the grand scheme of things of where this impulse might be coming back to. 50% of the level back down into these levels here. You see? If this is an impulse and I'm starting to see this market running back in here, this is an area of interest. So when I say it's an area of interest, means that if I was going to take a trade, really I want my stop to at least be outside that 50% 618 kind of area. All right? That's what I'm saying. That aggressive entry that we took on a 5-minute time frame, we got stopped out. We lost. That was an L. We take that as a loss. We don't turn around and be like, oh, take that as a loss. Cool, no problem. We tried to get in on a 5-minute entry. Didn't work. But I did push up initially, but the market came back down and stopped us out. We was too tight. That's fine. There's not a problem with that. Yeah. But we're looking at it. Have a look on the hour time frame. Is there anything that maybe I missed? Can anybody see something that I possibly missed on a larger time frame that would have kept me safe? This is a good question. Does anybody see something maybe I've missed on this 1 hour time frame now, which if maybe I was taking a trade, I would have looked at, but on in that example just a minute ago, I didn't look at. So we'll take it as an L, no problem. But is there anything now, we've gone out and zoomed out on an hour time frame that would have kept me safe from this action here, stopping me out? Remember, whenever I ask you a question, I don't want you to look up. I don't want you to look right. I don't want you to look down. I only want you to look left. Because left is history. Is there anything that anybody can see here that if I had taken it into consideration, I still would have been safe? Anything? Anything?
Is it imbalance?
It's the imbalance. Because if I was taking some trades from up here and I just zoomed out, I would have been concerned about this imbalance in here. I'd have been concerned about this energy in here, this imbalance in here. Now, if you think oh no, I can't show you. I was going to show you through the tool. The tool would have identified these two areas of imbalance. all right, that the market wanted inefficiency, that the market wanted to come and close. Okay, I can't show you now because they've been closed. So the way that tool is, let me see if it, now the way that tool is, once it's closed, you won't see the gap no more. Yeah, you can still see a little one at the bottom. See? You see a little bit of that little one here, this red little area that you can see coming and flashing on and off. All right. So that indication would have showed you both of those imbalances, the one above and the little bit of the one there, which it closed it enough, closed it 50% or more. Didn't completely close it. All right, see what happens. And then we go. All right. After that market came, tapped into. So what have we learned? This is the best thing to say. What have we learned is we've learned that if we take smaller entries, it's higher risk and higher reward. Okay. But what we should always be doing, regardless, is when we're going to place our stop loss, when we enter or before we enter the trade and we're going to place it, not after we enter the trade, before we enter the trade and we're looking for where we're going to place our stop loss, even if we looked on a 5-minute or a 15-minute, we have to be aware. We have to think to ourselves, let's look on, at least go and look on the time frames within your sphere. Within your sphere, you're talking about 4 hour, 1 hour, 15-minute, 5-minute. This is your sphere. It's where you're playing at. These are your guys. All right. If we had done that and zoomed that to a 1 hour, we would have seen this imbalance and it would have been a concern. So if we went and took that trade, which the previous one was somewhere over here on the 5-minute time frame, okay, we would have simply been like, oh, look at that hour imbalance, and at least try to cover our ass, cover those imbalances. Would have kept us safe here. We'd have still been in the trade as this market continued to go and rise out of that area. Now, remember, on the bigger picture, I'm saying that this potential little push could be is a retracement within this range. Now, that retracement could decide to hokey cokey like this, and then close in balance before it decides to leave. That retracement could missile straight back up into here quickly if there's some sort of catalyst. I doubt it. Yeah. Or that retracement might say, you know what, we're happy just closing 50% of this imbalance, maybe around this kind of level, and then we're going to go. I don't know. All right. I do not know. Have a look at it previously. The market came down here. Similar scenario. Look, similar scenario. Then the market came and pushed down here. At this point, we don't know. We haven't got the angle of the range. Yeah, this is in hindsight. But the market came down here and started to break structure bullishly. Okay, I'm on the 8 hour, but if I was on small 8 hour, but we can see here some concerns. There's some imbalances here on the 8 hour. If we go to our 4 hour, we'll be able to identify, some other concerns in there. If we go to our daily for sure, we'll be able to see these imbalances here, these imbalances here. All right. Look how the market didn't just missile back up in here to close the imbalances, because the market is bearish. The flow of the waters are this direction down the mountain. So, how difficult is it going to be for you to spike up like an absolute missile against the flow of the market? It's going to be probably difficult. You might be able to make some, hard graft. Oh, I'm swimming against the tide. I try and come and, I'm sideways for a little bit. Oh, I just pushed over there and I got the flag and now I can go. And that's exactly what the market did. Have a look. Tweedledeed and Tweedledummed, and then got up into that area. See? Tweedledeed and Tweedledummed, and then gave a little push up into this imbalance, and then decided to go at the top of our range. Same thing could happen again. Exact same thing could happen again, where the market kind of does Tweedledees and Tweedledums just to get to the opposite side of the bank of the river, and then decides to push down some more. Okay, so when you're trading against the trend, unless there's some crazy catalyst, some non-farm payroll, some this, some that, some significant news that's going to make this thing missile in an opposite direction, be prepared for this to play around and dance around on its journey. That's exactly what this market may do. All right, let's go look at another one. This was gold. All right, let's go look at another one. GBP USD. All right, a staple. And just have a look. Zooming out. All right, so GBP USD. Stubborn. Okay. Stubborn because here's the top of the range. all right, around this kind of area, trying to take into consideration this data point, knowing that on a bigger picture, this is at the top of the range, like so. Okay. I am bearish on this market. I want to see this market go to hell. But it's been just messing, all right? You know, it came, had a liquidity grab up in here to this point here, and then came back down here, and and it's just kind of going side. It's like, I beg you, do something. Yeah. So at the moment now, this is still the line, taking into consideration the highest point. And then the market is pushed all the way down here. So now I'm going to change this yellow box. I'm going to change it to this high, its highest peak over here, all the way down to where the market went to down here. The market is trading within this range. All right. Meaning that right now, these type of areas is getting into premium areas. Premium. Okay. If I draw some lines in, maybe some lines are going to look like this. Why is it going to look like that? Because I'm drawing a line that takes into consideration the highest point, the lowest point before the highest point over here. Okay. And I would like for this to give me some sort of confirmations, some sort of indication, some sort of correction, some sort of continuations. That it wants to break down. All right. Now let's look at it closer. All right. Let me try and get rid of some of these yellow boxes because they're hurting the eyes. So I'm going to just make this one have a border, a nice yellow border, a nice yellow border. And I'm going to remove the fill. I'm also going to get rid of this one in the background, which is just taking up eye space. Okay. All right. So let's have a look. The market was all the way up in here after going sideways. The market was in here, in this little range over here. And then we had a push out of that range indication. All right. I'm going to get rid of some of my squiggles. I don't know what these squiggles are from yesterday. It's me showing what I believe the market's going to do, which I'm going to essentially say the exact same thing again. All right. We've seen it indicate out of that box. What box you're saying, Jay? What box are you talking about? What box? What box? This box previously was in a box. It's in a bit of a range. All right, in here. Is it? Oops. There's in a bit of a range in here. Where the market wasn't really doing. It was making higher lows. Yeah, I'm not gonna say it wasn't. It was making higher lows. But on a high and ever so slight higher highs, but within a range. You know, it was within a range. Yeah, the market was in here within a range and it came up here, had a little wick, and then boom, it's broken outside of that box. Now, on a 1 hour time frame, I haven't really got a clean closure. Maybe this, yeah, so this is a clean closure on a 1 hour time frame. Is it? Let's have a draw this box properly. Yeah, this is a clean closure. But then we can see all of this concern, all of this concern, all right? Which is all of this imbalance over here. Okay, that, you know, in the back of our mind, if you get to say, boy, that market might want to come and close that imbalance, at least 50% of it. 50% is always like a kind of like it's a median, isn't it? It's like an average. It's like me saying, you know what, bro, meet me halfway. Yeah, I know you wanted to buy or sell at a certain price, but I can't get all the way up there. Meet me halfway. All right. So this market might decide it wants to come back in. It's at the moment, we are seeing this market potentially in a retracement phase after indicating what it may want to do. It didn't break this swing low, but it did break it. It pierced it, but on an hour time frame, it didn't close below this swing low. But this little pierce is telling. Yeah, maybe it pierced that level. It's telling. Doesn't not confirm that it wants to get down here. There's loads of orders, buy orders here that it's not ready. That's why market's been pushed back up to these levels. So I'm looking at this and I'm thinking to myself that this market may, let me draw some lines in. Yeah, make these lines yellow. May, it's not a great angle. If I make it do better than that. Maybe pushing up in here. All right. However way it wants to do it. Before, I'd like to see a continuation coming down bearish because I'm bearish on the market anyway. I think it's pushing up. It's in a premium kind of area anyway. It's not at the top of this premium area, which is this line over here. It's not right at the top of the brink, and it could decide it wants to get all the way up here. So this could decide it wants to keep pushing up here. Don't get twisted. It could definitely decide so. Yeah. But at the moment, we're in here. So I'm going to be waiting personally. I could draw another little line in like so for now. This is based upon the data I have. In fact, it wouldn't be like this. Sorry. It would be like this because this is the highest point, this red little wick. So I'll be waiting now to see this, if this is going to break above here, put in some lines. I want to see on a maybe smaller time frame, 15-minute time frame here. Yeah, I'd like to see the price breaking outside of the market, breaking outside of my trend lines. At the moment, this trend line here is not valid. It's at the moment it's like this. Why is it like this? It's like this because this is the highest point. Oh, well, it was a minute ago. It was just a minute ago. It looks like it's about to be broken. And when it gets broken, then I need to change this angle because I got new information. Yeah, I can't change the angle before I've got the information. So at the moment we're like this and it's trading within this range, but as soon as this market pushes up here and this becomes the highest point, well then I need to touch the lowest point before the highest point. The last lowest point, swing low before the highest point. And then that would be my range, something like this. But hoping that this market hits the top of this ceiling here and starts to turn around. This is quite simple. I'm not gonna lie to you, it's not complex. What is complex is putting them all together, making this picture, and then being composed enough, having enough composure to be able to get into your trade with the right kind of risk. All right. So I'm going to pop an alert in here. Add an alert crossing up. I'm also, more importantly, you get one an alert if this market starts to break down, down, down. All right, crossing down. I hope you understand that whole breakdown. If you don't understand my analysis, and like I said to you, this market crossing up, my alert is here, because it could very well decide it wants to close up this imbalance, trade within that nice little blue range it's making maybe, right? And trade and close that imbalance up. That's fine. I could get in here. I could be in here for the buy. Should I show you the entry? I can show you the entry. This market here, if I wanted to trade the retracement in history, that would have been the line taken into consideration the last high before this lowest point. Drop my time frame down because I wouldn't be looking at our time frame. Yeah, because I'm trying to get in on a retracement. For this argument, I'm going to go down to our 5 minute, but I'm going to make sure I learn from our other example and we go and check our higher time frames. It's pushing up, so I can change that angle. We can see how the market came, indicated above these highs, indicated, corrected. Where did it correct to? Have a look. Let's pull out our Fibonacci and have a little look. From here, this impulse up to here, connected in between our 50% and our 618. This is the 50% area. When I say 50% area, I'm talking about 50%, 618, and the 786, this golden zone. This whole area is an area, a reversal area. Okay. Okay, so that's what it did. Came and touched into there. And then we saw a reaction, boom, 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 this market coming all the way up into here. All right. Now, if I wanted to enter that trade wherever that candle closed, the safest place to enter that trade would be, place our stop. Look, let me show you what my problem is. In fact, yeah, cool, because we wouldn't have had these data points yet to turn around and draw and know that we're at the top of the range. If I take this trade, my stop has to be below this swing low with my spread times. Even when I go below this swing low, I can see some imbalance, even on a 5 minute time frame here. It's a concern. All right, let's look on our 15-minute time frame. What did I just say? I said we're going to place our trade based upon, the information we've just taken in here. Look, look, look. On the 15-minute time frame, this imbalance in here, I'll draw it so you don't have to keep using your eyes, is a concern. I mean, so is this one if you don't want to go there. They're all concerns. But below this swing low, which we're saying this market wants to respect structure if we were going bullish, but it could always do a little crazy little wick down here. This would, at minimum, I'd have to put my stop here to take into consideration this imbalance. Putting it down all the way below here, yeah, that's a bit something else-ish. Let me go to the 1 hour and see. Where is it? Where's it gone? Yeah, on a 1 hour time frame, yes, we can see here that this is structure, and the market could come all the way down into here. All right. Yeah, well, sorry, we've already said we're accounting for that one. All the way down here, yeah, more unlikely to. It could do. The market was going sideways. Yeah, but if it's going sideways, you don't want to be in sideways action anyway. All right. So I'd say, here is a good place to place your stop and have a look at the market. Came back up came here, pushed down, took into consideration that imbalance over here so that we're safe. Didn't even bother go down there, but we were safe. And the market continued to push up. And we're here now. Because this would be if you're trying to take into consideration this trade and maybe trade up and get involved in this closure of this imbalance. Lovely 1 to 1.5, 1 to 2 trade. That's you trading the retracement. Okay, that's you trading the retracement. Now, I'd prefer, let me show you what I'd prefer. Once I've seen this market come up here and then come down there and I'm able to draw in this angle, I would much prefer taking a buy from a discount. When I said here, when the structure broke or whatever, maybe here, I wasn't in a position to draw the range. I didn't have enough data to draw the range. But here, when I've got these data points here and I'm seeing a reaction, I'm in a better place to be able to turn around and say, okay, I would prefer to buy from the bottom of a range, from somewhere in here. And on a smaller time frame, just to show it to you so you get even more confidence, because this isn't one I made earlier. I'm just doing this live. All right. This is on a 5-minute time frame. Hopefully I don't have to go any smaller. Maybe not. All right. So I can see the entry, but I can see that maybe we may have to go down a little bit smaller. Have a look. So this market is pushing down within this range. When we draw this line here, I'm taking into consideration this last high before this lowest point. But I can also see on this impulse that this here was a high before this lowest point, but you just can't see it that well. Watch when I drop the time frame down for argument's sake to a 1 minute or 2 minute, then you'll be able to see it. And that's why I said, I don't really want you guys in here 1 minute, 2 minutes, because he's just giving you extra things to think about that you don't need to, maybe even developing impatience in the markets. Can you see where I put that line? You see how I was able to see it on a 5 minute when maybe somebody else couldn't see it? This was a last high before this lowest point. And on that basis, watch. We've seen the indication. We've seen the correction. I'm not even going to call this. I'm not going to say this is the continuation. This is just wick. All right? This is just wick. So markets come back down here. So this becomes the indication, not closing down below this structure. So this becomes, have a look, indication. All this becomes correction. Once it doesn't break this structure, we're still good. But this is the place where you're understanding. So we're waiting for a closure above this little wick here, which maybe comes, let's have a look here, maybe comes right here. That would have been your trade. That would have been your entry. Now, again, I'm going to keep saying it to you so you can see it for yourself. There is multiple entries here based upon what type of trader you are, based upon your risk appetite. High risk, high reward. Lower risk, lower reward. I normally advise for people that haven't experienced taking good trades and growing an account, take the low risk one. The low risk, or there's even 3 entries. There's like I said, there's high, medium, and low. Okay, so these are all based upon an entry because of this candle over here. Oops, because of this candle over here. All right, that's an arrow, believe it or not. It's an arrow. There you go. It's a terrible arrow. It's like a kite. It's like something mad. I don't know. Let's get rid of that. All right. Either way, based upon this candle over here, there's multiple entries depending on where you want to take them. All right. This is the high risk one below the last low of your spread times 2. High risk, high reward. This is your medium risk below where the market retraced to over this here level. Yeah. All right. This is really the recommended one. Okay. After the market indicated where the correction was below that correction. And obviously the one which is like raw, you're really overly safe, is below this swing low. Okay. Now we can see in this instance, have a look when we hit play, that they all do well. So the high risk guy, he won in this instance, even though he had to hold his wee as the market came all the way down here and looked very closely at his stop. He lived. He lived and he prospered to the tune of, in this instance, a lovely 1 to 4 trade very quickly. Yeah. As the market came up here, pushed. Now have a look. In every one of these instances, this is what I want you to draw your eye to, and then we're going to finish up, is that the market never once indicated, corrected, and continued, not even on the 1 minute time frame, against any of these entries. Look, here we do see an indication in the wrong direction, breaking this structure. Look, boom, we do. We might have even started to see a correction in real time if he's looking at this, but did it continue? No, it didn't. So why would you be out of the trade? Still in the trade. Over here, the market broke this structure, ish, kind of. This might have been the correction, and maybe it was the end of the line as this market comes and continues. Did it continue down below? No, it didn't. You're still in the trade. Maybe here it came down here, looked at it. No, didn't bother. Looked at it over here. No, didn't bother. Looked at it over here. No, didn't bother. Came up here and started to go sideways. Then we had an indication. This might have been, you're looking at it, the market's coming back up in here. Correction. Closing down below. Now, in fact, what am I talking about? I'm not even going to say it. Yeah, correct. You're out of the trade. Why are you correct? So I'm looking on a 1 minute time frame. This is the highest point. If you was to draw a line in here, your line would have been looking like this. Look at this data. Coming up here, trying to touch that last low on the 1 minute time frame before that highest point of the wick. If you can't see it, let me zoom for you. Okay, as this market was going sideways, this wick created the highest point. As soon as the structure starts breaking down below this level, have a look at this candle here that closes below, then this is all indication. This little energy coming back in here, it's potential correction. You just get out. You done well. Get out. Made your money. Yeah, or you'd have got out on the basis that you was happy with hitting your 1 to 4, which is a great trade. If you keep hitting 1 to 4s, you'll be a millionaire in no time. All right? In no time. And since then, obviously, this now, since you start seeing this breakdown in structure, if I even start zooming out of this, going to my 5 minute whatever, it starts to serve. Well, in fact, sorry, prior to that, the reason why you'd be getting out here, even better, is because, from this data point here, yeah, this is really coming together, and this data point here, you was able to pull out this top range, top of the range here. You was able to pull this out. So all of this energy over here, if you was in this trade from down here, where are you now? When you get up here, where are you now? When you got into that trade down there, where are you when you got all the way up here?
You're in the bottom and now you're at the top.
That's right. So if you was in there with your money and at 1 to 4, you're thinking you should be nervous, biting your nails like, right, we're in a premium now, man. Man might start dumping off. Man might start selling. So you should be looking for any excuse, i.e., this being your stop. You should be looking for any excuse to take yourself out of this trade, moving your stop as you go, because you're in an area that ultimately man are going to dump off on you. What happened? Dumpage, dumping off. Unless you was in it for a much higher time frame target, and your stop remained below swing lows. Below swing lows. Because if you put your stop below here and you believe this market's trading up within this yellow range, well, you're not going to have any troubles with your stop down here, are you? If you think the market's going to stay within this yellow dotted line. Even if the market decides to go, wee, which I think is a travesty, because you was up so much profit, 1 to 4. If you want to go take it all the way back down to 0 minus, that's down to you. But only if your stop is in a safe place. If your stop is in here, you're not safe, because this market could come down to this yellow line and stop you out. So I'd be happy taking my 1 to 4. What is a 1 to 4? That means you gave me £1,000 and I came back in how long? Let me show you. Take my ruler, measure from here to here. You gave me £1,000 and 5 hours and 20 minutes later, I came back with 4,000. And I said, here. And what, you looked at it and said, nah, not enough. And left me with it for another, I don't know, however long. Why would you do that? I'd be like, thank you very much. Let me have my 4,000. Yeah? And next time you got something going on, let me know again, and I'll give you another 1,000 so you can bring another 4,000 to me. Instead of me staying in the trade and going all the way back, quay, back down to here, back down to a 1-to-1 or 1-to-0, whatever it is. Why? I don't need to do that. I want my money. Personally, I want money. Give me my monies. Now, we've seen the market come down here, and because this data point, this market came down here, didn't break this structure, and then broke structure bullishly, now this becomes a new data point. So I can draw this blue line, and then I can draw in, pull it out a parallel line from here. Look, this is completely parallel. Look, if I put them on top of each other, they'll disappear because the angle's the same. And then I pull it out to where? The only reference I have is this highest point here. That's where I pull it out to. That becomes my new trend. This becomes the new trend. The guy at the club is seeing people now coming in with the little flares at the bottom where they cut the ends. It's a new trend. In here, in this blue range, is this trend going to be able to break out of the general trend of people actually wearing trousers? This bigger yellow trend is that the bigger trend of people actually wearing trousers. Is something going to change? And we're going to start seeing man in the club in shorts, because we've broken outside of that trend now, and trousers ain't a thing now. Shorts is the thing. That's the bigger Russian doll. The bigger Russian doll is that we're wearing trousers. Whether they're going to be straight or baggy, trousers is the category that we're in. Are we going to break outside of that category and do something else? Well, I don't know. I don't know. We can see imbalance up here. Maybe we're going to break outside of it for a little while. You know, it's summertime and people are going to start wearing shorts as we break up in here. Close that imbalance, and then it starts getting cold again, winter time, and then we get back into trousers. And furthermore, we get back into some, you know, thick woolly jumpers. And furthermore, we're doing something else. The trend had changed again. You see, I paint these metaphors to show you, like, to let you understand that this isn't that complex. It's about reading and reacting what the market is doing and understanding what the market likes and dislikes. Yeah? It's really not that techy, all right? It's just more, say, about doing your checks, doing your multi-time frame analysis. That first trade that we took, and I was saying, yeah, we could take this trade, but we didn't zoom out and at least get to an hour to see any concerns. We took it based upon looking at a 5-minute time frame, and we paid for it. We took an L. I don't care. It doesn't make me stupid. Me, I can take 5, 6, 7. I can have a 30, 40, or 40, 50% win ratio and still pass challenges in a couple of days. Or still make money in a couple of days. Because I understand that losing is part of the game. It's not like, oh my gosh, I'm an idiot. I can't do this. Every trade I take is rubbish. No, bro. It's not every trade you take is rubbish. It's that you're going to lose. You're a human being. The markets are unpredictable. And you don't have a crystal ball. Sometimes you can accept that you're going to lose. Like I was listening this morning, you know, some motivational stuff. I don't know if it's the one that was playing this morning. And you see, like, successful businessmen, people that are successful in business are just people that can lose very well. Like, keep losing. They can keep losing really well. You know what I'm saying? Start a business, failed. Keep failing very well. Start a business, failed. Start another business, failed. Started with a total flop. Start a business, flopped. Start a business, it's Amazon. Does anybody ask about Jeff Bezos' other businesses that didn't do well? Is anybody intrigued about that, saying, you're a waste man, Jeff Bezos, because your first 8 businesses flopped? Is anybody concerned about all the shots that Ronaldo misses? Waste man, missed 10 shots today. Well, no, he scored a hat-trick and we won. He shot 13 times. He had 13 shots on goal, scored a hat-trick. The team won. He's the man. He's top. He's the man. He's Ronaldo. All the kids want to be him. But he did miss 10. Over the bar, lip crossbar, blah, 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 blah. No, we're not talking about that. You see, the people that have a problem is they'll miss the first 5 shots and their head drops, man. They're scared to take another shot in front of the man them. They're going to go and take another shot and miss again. They're scared to take the shot. When the opportunity comes, they pass it. They pass it off to somewhere where they shouldn't have passed it, where they should have shot. Or the person that had that business that failed, they don't want to launch another business because they was ridiculed. Man laughed at them. Your other business was a flop. Your other idea was a flop. you got involved in something and it was a scam, or this happened, they head drops, they said, you know what, I'm gonna go back to just working in Argos. No disrespect to anybody who works in Argos. They just say, you know what, it's not for me. The winners just keep failing their way to success. Just keep failing their way to success. Just the laws of probability. One of them's gonna stick. You just gotta survive so you can fail your way to success. Forget about that. You just want to hit success straight away. Of course we do. Who doesn't want to just go like that, come to the dartboard and like that, bullseye, bullseye, bullseye? Who doesn't want to go and buy one lottery ticket the first time they've ever played and go and hit the lottery? Who doesn't want to go and find, I don't know, the love of their life, the first gal that walked past their house when they decided to go into the dating pool or man? And that's, of course that's what would be great. But in reality, you have to fail your way to success. In reality. All right. So what have we learned? And what is my point? My point is that this trading thing is about risk management and it's about having an edge. Yeah. If you can have risk management and have an edge, probability, you'll be able to take trades and understand that once you stuck to your strategy, you feel no guilt because it's not in your control. It's out of your control what happens. Is right now we could be in this saying, yeah, this market's going to go up and up and up and up. Some crazy event happens in the world or some news that we wasn't aware that was going to have such an impact on the markets. And we just get a wick in the wrong direction that just stops us out. Yeah, look at this today. This is today, Wednesday, June the 12th. We've got red folder CPI news. We've got core inflation, CPI. We've got all this red folder stuff happening. We've got Mr. Guido's speech. We've got some Fed interest rates happening at 7. We've got things happening today that mean things are out of your control. The waters are not calm for you to do all your tricks. You know, you're a surfer and you've got bear tricks that you can do. You know, once it's calm, you can do bear tricks, flips, spins, I don't know, whatever they do. When it's mad and there's waves and chop and stuff everywhere, you can't do all of it. Like, it's out of your control, bro. The only thing you can do is hold on or do this one move because it's mad. Yeah? So don't be disheartened by your losses, guys. Just understand that if you bought a challenge and you blew it too quickly or whatever it may be, manage your risk better so that you can survive. Yeah? Manage your risk better, make better decisions, take better choices about what you want to trade. Look at it and be like, nah, this isn't looking great. It's not really at the top of a range. It's not really in a premium for the sell. It's not really in a discount for the buy. I'm going to leave it alone today. Be more discerning. You see, if I've got my kids in the car, and even when I ain't got my kids in the car, and you're trying to take that exit onto the dual carriageway. Yeah, you're on a side road for the people that will drive. You're on the side road, you're trying to get up to that dual carriageway. If your car's, you got a big engine, you know you got the acceleration, you could just nip out. You're forcing it a bit, but you can nip out and accelerate and you're not gonna lick nobody. Nobody's gonna die. You see, if you're sitting in there with your kids and your missus and your prized possessions in the car, I tell you, I'm just gonna let my man go past. I'm gonna wait for a bigger gap. I don't need to risk it. Why do I need to risk it? Say I come out and for whatever reason my car stalls, or I don't know, the other car accelerates, so I'm not able to pick up that speed, and I just cause a pile up with my utes in the back. Because of what reason? Where I can be more discerning and say, you know what? Patience. And just understanding what it is you're trying to achieve. What am I trying to achieve by getting out and accelerating like a lunatic in front of Donny that's doing 60 miles per hour on a dual carriageway? What am I going to gain from it? What are you going to gain from taking a trade that doesn't look that good? It's just like, it's not great. It's not in a premium. It's not in a thing. It hasn't, there's news coming out. What are you going to gain by taking that trade today when you could wait till tomorrow and take up a trade that looks fantastic? Or you can wait till even later on, furthermore, not even tomorrow. You can just later on, wait till it gets up into your zone, into your area. You got to look at it from that perspective and think to yourself, you know what, damn, should I risk the utes and just quickly shoot out in the dual carriageway in front of this lorry? Or should I just wait till the lorry goes past? Wait till the lorry goes past. If you're really serious about this thing, you want to get some money at the end of the month to go and buy yourself a big train. Yeah, to go and do some things, take your family around the holiday, you're not going to risk that. You're not going to play with that goal. You're not going to ramp with it. You're going to take it serious. The people that do well take this thing serious. They stick to their strategy. They're like, I don't like it. I'm not taking it. The people that play with it, and we're all guilty of it because we get the bug and we're impatient and that they're gonna go like, oh, it's closing right now. I'm gonna take it. The FOMO kicks in. I'm gonna hit the button. And they get so excited that endorphin hits when they hit the button. When they click, oh, they feel, I'm in a trade. Woo. In reality, when they look back at it, or if someone else was to look at it, they'd be like, bro, it looks a bit rubbish, bro. Think about it. You wouldn't do that in any other walk of life. You're not going to go to the fruit and veg store and pick out the apple that's looking all meaty, all shrivel up with a little brownness on the side. Why would you do that? When you could look, you could move it out of the way, move it, boom, boom, pick up one that looked perfect. Or furthermore, even ask boss man, listen, when are you getting some more soursop in? When are you getting some more, oyster mushrooms in? Because these ones looking a bit, And he's going to say, I'm going to get some later on at 4 o'clock. No problem, boss. I'm going to be back at 4. That's what you do in the real life. You wouldn't just because you're there. I'm at the veg store. I might as well take all the mushrooms that look like they're all going green. They're all moldy. They're all brown and wet. You're not going to do that. Take the same attitude to your trading. Guys, good morning and God bless. There is some news today to be aware of. Time-wise, be aware of 1:30. We're getting core inflation news. Also, later on, you'll see there's some interesting things happening at 7 o'clock. So what that might mean, it might mean that the market might not do too much after we see we might see some erratic energy at 1:30, but then the market might really slow down and wait to see what's going to happen here at this Fed interest rate decision. Or on the flip side, we might get some movement in the market anticipating. Because look, the consensus is that nothing's going to happen here. Look, the previous is 5.5. The consensus of what people think is 5.5. So the market might just say, who gives a damn about this? All right, but we also got FOMC projections. Sorry, chewing gum tonight. Projections, and Alan's put something in the group in regards to what's going on today, and so be aware of those things. But guys, good morning, or amazing, not good morning. Forget about that. Amazing day. All right, amazing day. I'm not mourning anything this morning. All right. And furthermore, I want a whole amazing day. All right. I don't just want some good stuff in the morning. I want the whole day to be amazing. I'm going to put something on. I'm just having a look. All right. So I'm going to put something on. It's not going to be trading related. Sorry, we've got some trading related stuff of a couple of days. It'll be something different to hopefully broaden our knowledge base. Okay, so a little documentary. All right, so what we'll do is I'll just play a little motivational video by Jim Rohn. It's only 15 minutes. And then afterwards, there's a documentary that says The Men Who Stole the World. Looks interesting. Men Who Stole the World and Got Away with It. And we'll have that playing. If you don't want to watch it and you're going to go out with your day, guys, have an absolutely amazing day. If not, it's maybe just something else we might learn, or maybe something in that motivational talk might just spur you on to do something great today. All right. And that's what it's all about. Yeah, have an amazing, amazing day. I'm going to try and do what needs to be done today. Thank you very much for your time, guys. Very grateful.
Governed by laws, the universe, in fact. Laws. We call it the law of electricity. We call it the law of gravity. There's mathematical laws, there's physical laws, speed and velocity laws, agricultural laws. Now that we find ourselves on the spinning planet, you just have to learn what I call the setup. Learn the setup. Life's setup. Now, we didn't set it up, but